All right, well, good afternoon, everyone. My name is Dan Charlie. I'm the president of Alpine Brokerage Group, and I wanted to take a moment and introduce today Josh Vandervoort. Josh said, I hope I didn't butcher that. I've been practicing that for about an hour. But Josh is the regional vice president for RIA life sales for Nationwide, and I have to tell you, I'm pretty jazzed up about this product, and I'm excited about it. I actually messaged Josh this morning that I'm looking to do this for myself, just because I love how many different applications this product can really fit inside of your financial plan or your client's financial plan. So really, whether you're looking for flexible death benefit protection, you want to secure your insurability for later on down the road. Maybe you want to manage your cost of insurance inside of the product, just build some cash tax deferred, or access the long-term care rider of a very, very solid insurance company. This product has all of those availabilities for you, and I really like it very much. So I've been talking a lot about it when I've been out speaking with financial advisors. I think it is a unique product. It has some very good niches. You kind of can have two bites of the apple. If you want to, you can be the insurance person on this, but you can also be the asset manager. So it has some uniqueness there from the advisor's perspective. And I thought it would be good for Josh to jump on and really talk about the nuts and bolts of this, and how this presentation will really work is that we'll have about 30 minutes of a presentation and then maybe 15-20 minutes of some Q&A that we can tee up for those of you that are going to be on the call. So Josh, take it away. Let's go ahead and dive right into it. As I said, most of the advisors have heard me talk about this program, but I really want to get into your side of it and how it really works. So thank you for coming on today, and look forward to hearing all about it.
Yeah, absolutely. Thanks for having me on here today. And you brought up such a good point of you getting it on yourself. It's funny, I typically will go about 2/3 the way through the presentation. And if we're all on camera, you typically can kind of start to see advisors' eyes kind of widen a little bit. And I'm like, I know what you're doing right now. You're deciding, how much do I get on myself, right? And I love that advisors get it on themselves. And then typically about 2 weeks later, I get a follow-up call, and it's, okay, now we're going to do it on these clients, right? So it's probably the first product out there that I've really seen that in the RIA space, the partner gets it on them, and then it's within a matter of months that it's on all of his top clients. So great product to really look at that. It's transparent as you can really make it. So as he said, I'm going to go through, do a little bit of a presentation, then I'll pull up some numbers, go over the true nuts and bolts of it here. If you have questions, feel free to type them in the chat, and we can get to them here at the end, just as we're going through things. So you should be seeing my screen here now, and this is just going to be a few slides that we'll go through, but I just like to talk about life insurance just in general first, right? And let's talk about the tax treatment of life insurance. I think that's something that's so often forgotten about. When you hear life insurance and you immediately think, okay, we're going to just pass a death benefit on to the beneficiary. This product can be so much more than that. So if we look at here, life insurance income, right? So let's focus in on that income here for a minute. It's federal income tax-free, state income tax, local income tax-free, capital gains tax-free, net investment income tax. You get the point, right? It is sheltered from as much taxation as we can possibly make it. So it makes it not only an effective planning tool for death, but it also makes it an effective tool to utilize in retirement or to utilize as an income supplement. And that's really where we're going to focus this product conversation on today, is how can we use this contract while living? So let's talk about some objections to life insurance, because I think a lot of people have them. There's a lot of negative things out there in the press or that people kind of talk about when it comes to life insurance. And my goal here is we're going to go through these 9, and then throughout today, I'm going to tell you how we overcome every single one of those 9. So sales loads and other insurance charges perceived as expensive and complicated. That's an objection we hear in the life insurance business in general. Surrender charges that reduce liquidity, lack of licensing or broker-dealer, fear of alienating clients with a negative experience, fear of coverage lapsing, limited attractive investment options, difficult to manage the money, fear of losing AUM, and getting paid to manage the money is more complicated. So those are probably all objections you've heard or you've even said yourself. And my goal here today is let's overcome those objections. Let's provide you the resources to be able to overcome those objections if a client brings that up in your next conversation. So we'll start here. How is this different than other VULs out there? So if you think about a VUL in general, it is we want to pay a cost of insurance, and then we want money to go into the market and for you all to invest. Well, oftentimes there's a lot of sales loads, there's a lot of surrender charges, as we just mentioned. So this product, there are no sales loads. So that overcomes that objection right there. Typically a sales load is 6 to 12% of premium. This is 0. It's been eliminated altogether. No surrender charges. Typically we see surrender charges of 10 to 15 years in the market. It is 0 on this product. So when we couple those two things together, you really get a pretty attractive option. One on new money, right? As new money's coming in, it's not getting hit with all these heavy upfront charges. If you're putting 100 grand, 200 grand into this, that's truly what is available to the client. They're not going to see putting 100 grand in and then taking a $60,000 surrender charge. This is, we're putting $100,000, $200,000 in, and it's there. Where I really like the applicability of that is 1035s. Go through, I know it's tax season, right? So you're meeting with clients or you have quarterly reviews, semi-annual reviews. Go through their insurance. Ask them, what do they have in force? They may have an existing IUL, VUL that's out of surrender, or a whole life that, you know, somebody down the street sold them when they graduated college and they haven't done anything with it in the last 30 years. Take a look at those and see what we can do to bring them over, because it's not going to get hit with a sales load or a surrender charge. Goals change, and this is now could be an attractive option for those folks. Fee-based, so that's in that top left-hand corner. That should be the obvious one here, right? That it is a fee-based VUL. That is what is different about this product. What I mean by that is you have the ability to easily manage the funds and get paid on the assets. So you can take those advisory fees directly from the contract, it would come from the cash value, or you can bill it from another asset. What I mean by directly from the contract or outside the contract. Directly from the contract, it's no different than you taking it from a brokerage account, right? Just like you're already doing on a daily basis. That would just come out of the cash value here instead. Or we can aggregate the assets for you with your other AUM through portfolio management softwares like Tamarack or Orion or Black Diamond. We connect in with about 90% of the aggregators out there that will allow it to easily flow into your online systems and have everything in one spot. As a consumer, right? Let's think about the consumer there for a minute as well. How easy for them to be able to see, you know, you build this as such a valuable asset of your firm to be able to see the brokerage account, their 401k all in one spot. Why wouldn't their life insurance be included in that? And we've really built that out to make sure that is the case here as well.
Now, Josh, just to touch on that a second, because you and I have had some lengthy conversations on that. You know, that is built on the backbone of some of the fee-based variable annuity platforms that Nationwide has. And so this is not something that, as you said, that Nationwide just started doing and they're trying to figure it out. This is a well-oiled machine that is able to affect different asset changes inside of the product and reporting and platform integrations with third-party softwares that are out there. So can you spend a minute or two and maybe just dive into that just a little bit deeper?
Yeah, so this isn't something we just decided to do overnight, right? So it's something that's there, it's been built. You may be familiar with the company called Jefferson National. They're based out of Louisville, Kentucky. They're the market leader in fee-based annuities. They control a significant market share in the fee-based annuity space. And Nationwide bought them 5 years ago, not only for the market share and the product, but we really bought them for the technology. Insurance carriers, and I've worked for one for a while here, have historically been bad at technology, right? So that's probably, it's one of those pain points, right, that we talked about at the beginning. And this overcomes those objections with technology. I've never seen an insurance carrier have the technology figured out like Jefferson National did. We rolled it into Nationwide, we rebranded it as Nationwide Advisory, and this sits on those platforms. So it feeds in through all the data aggregators. It is really, I view it as, it's built for money managers and just happens to be insurance. So if you look at it, you're able to group trade or block trade, right? You've got 40 clients and you want to sync them to 3 different portfolios. You're not going through and clicking on 40 different contracts. You're doing it in one swift click, right? It is as easy as we can make it. It is built for you to manage money. And so I think that's really the key when it comes to this platform is We're not taking it away from your AUM. We're not making you do something different. This is built for the RIA in mind. And how can we make it as easy for you all to manage the money? And I think a lot of that comes with the bullet point at the bottom here, the over 140 funds on the platform. Most VULs out there have between 40 and 60. A lot of times they're insurance carrier funds, right? So those typically aren't the funds you want to utilize. You do it because you have to. But here we're going to look at Fidelity, we're going to look at Fidelity, we're going to look at American funds, we're going to look at DFA funds. We've got 144 different options. We're actually increasing that to 150 here on May 1st. So you'll see some additional funds coming in here, but anywhere from your low cost Vanguard funds all the way up to your actively day traded RIDEX funds and everything in between. So it is built for you all to manage money. Customizable temporary guarantee. So that's a mouthful there. What it really means is we're structuring this contract as buy term, invest the difference, and one tax advantaged wrapper. I'm going to show an example of that here in a little bit, but our whole goal is how can we get as low cost of insurance? That way everything is going into the market. We want as much in the market as possible. That is where Nationwide's profitable. That's where the client wants the money so they can make more money. That's where you all want the money, right? We are all three in the same boat here. We want the money in the market and we want you all to easily be able to manage it. So I'll go over a sample here in a little bit so you can take a look at that. Another objection we hear in terms of just the regular insurance space that we've overcame here, simplified underwriting. That is where I can't tell you the number of clients that if they've had a poor underwriting experience with another carrier, with another product, they don't want life insurance, right? They view underwriting as complex. What we've done is we have abbreviated it down. It is simplified issue. What I mean by that is we will send a link to the client via email. They will open it up. They will go into a secure portal. It takes about 15-20 minutes for them to answer underwriting questions. It is reflexive based on their medical history. So we know from data on the back end, if they're on high blood pressure medication, we're going to ask questions about high blood pressure. It is geared to be as simple and as easy as possible. It is available for up to 5 million of coverage and up to age 64 for simplified issue. Over 64, over 5 million, that is where full underwriting will take place. But this is a standard or better product. So standard, standard plus, preferred, preferred plus. We are not doing table ratings. We are not offering flat extras. This is your average health client or better. It is intended to be quick. If we get an application in the morning, our goal is to have it approved by the afternoon. If we get an application in the afternoon, our goal is to have it approved the next morning. So that's our goal. We typically will run under 24 hours ultimately at the end of the day. So it's a very quick and abbreviated process. There's no labs. Yeah. And that's, nobody wants to get pricked, right? So it's how can we make that as easy as possible?
Absolutely. And I'll tell you from talking to advisors, most of them are kind of, trepidatious or concerned about the underwriting process as it relates to putting their clients through it. Number one, because they don't understand it as the advisor. Maybe insurance isn't their first and primary business. The second thing is, they don't want to interrupt a relationship that they have maybe 20, 30 million on their platform, have the client have a bad experience in underwriting, and then all of a sudden those assets are moving to another asset manager. We've all heard those stories. So I think this product, kind of helps you put that toe in the water. If you're not traditionally writing this, and maybe you're an asset manager and you're looking at this product as a complement to what you're currently doing, or to bring some outside assets under the tent on your platform, it gives you the opportunity to offer the coverage without going through the hassle of the medical exams, the records, the labs, and having to explain that process. Now, not everybody makes it through there. Obviously, we understand that. But, 18 to 64 up to 5 million is pretty aggressive when you look at the landscape of who's doing the data-driven or AI-driven underwriting with ordering medical prescription checks and those types of things. So I was happy to see that. And that's something that I'm going to be interested in when I get my policy, kind of going through that process as well.
Yeah, and I was in Columbus last week at our corporate office going through just some strategy meetings for the year. And one of them was with underwriting. And, typically as a wholesaler, we like to go in there and complain about underwriting. And we walked in the room and I said, I've loved everything about this. I think the look on their face was just in shock that, you know, we've had such a great underwriting experience with this that I had them pull the statistics for me. 85% of clients are getting preferred or preferred plus on this. That is insane.
Wow.
That is insane.
Very high. That is very
So,
high. Usually it's like in the 60s. So that's pretty high.
Yep. So great experience there. So overcome that objection when it comes to underwriting. Funds we talked about already, but just a really wide array. We intend for them to be in the market and in these funds, but we do provide 2 indexed interest options if they're interested. I see these oftentimes used for clients that are in retirement. How can we diversify? How can we de-risk a little bit rather than being in the sub accounts? So we offer those an S&P point-to-point or a 1-year multi-index monthly average. They are out there. They can be utilized just as an additional diversifier. In terms of nationwideadvisory.com, so that was that platform that we talked about at the beginning that Dan and I mentioned. It is intended, it is easy for you to use to manage money, right? It is your one-stop shop. If you've done fee-based annuities with us, it's the same exact login. It'll be in the same exact spot. In fact, you can trade on the annuities and the life products at the same exact time. So as easy as we can make it. I highlighted on this early on that we're integrated with all the major data aggregators. Just to name a few, Allbridge, By All Accounts, eMoney, Tamarack, they all feed into hundreds of others like Black Diamond and Orion and plenty of other options out there. One of the things Dan mentioned at the beginning was the ability that this is so multifaceted in where it can be utilized. The main play is for income, right? Let's not get sidetracked off that. The main play is let's front load this. Let's put a good chunk of change in there and have it grow in a tax advantaged bucket. But we do want to make sure there's still a little bit of insurance on here, right? We still want to make sure that this lives up to the protections that clients need and that Nationwide wants to offer. So this comes included with 4 included riders and 1 optional rider. So the 4 included are an accelerated death benefit for terminal illness. So terminal illness rider, we have a critical illness rider, a chronic illness rider, and our overloan lapse protection rider. So that 4th one doesn't get talked about enough. So overloan lapse protection, life insurance is tax advantage to take all that money out tax-free as long as it doesn't lapse, right? So we need to avoid a lapse on a product. That was one of those objections at the beginning. I'm a big basketball fan. Dan and I were talking that March Madness is coming up, and I'm sure as you've watched commercials for various football, basketball games, there's a Volvo or Volkswagen commercial where they're pulling out of the driveway and the car slams on the emergency brake for you, right? That sensor's there, a dog runs behind it or something. So that emergency brake is applied. I view the overloan lapse protection rider as that emergency brake. Right before tragedy occurs, we apply that overloan lapse protection rider, buys a small paid up death benefit to ensure we don't lapse the contract, locks in that tax-free savings, that tax advantage savings that really those clients want, and to create a better experience for you all as well. The only optional rider is our long-term care rider. It is industry leading cash indemnity LTC. You can elect 2%, 3%, or 4% at time of issue. And that is just a dollar for dollar acceleration of the death benefit. So if we've got a $500,000 death benefit at 2%, go from 500 to 490 to 480 to 470. We're sending you the money, direct deposit or a check, whatever you prefer, spend it how you deem fit, how the client deems fit for their long-term care need. It is,
Josh, I call that rum and cigarettes money.
we talked to a client. You can
literally use it for whatever you want. I'm just kidding.
Whatever you want.
Yeah.
I talked to a client one time, and she was a really wealthy client, and she went on long-term care claim. She didn't need the money, and I said, how are you utilizing your claim? And she said, I have 5 grandchildren. I can't go visit them. I'm using my claim for them to come visit me. I'm paying for their flight to come visit me, and before she passes away. So it's so flexible. Utilize it for whatever they need, and that's how long-term care should be, right? We want it to make it as easy as possible. I'm going to pivot over to an illustration here in a minute, but I always like to go through just a little bit about Nationwide. I came from our finance department to start here, so I always like to go through a little bit of our ratings. We're a Fortune 100 company. We are the most diversified insurance company in this country. You probably know us for our Brad Paisley, Peyton Manning commercials that talk about our home and auto. but we are a major player in the financial services business. So we are strong, we are stable, we are very well diversified. And the fact that we have home, auto, life insurance, annuities, retirement plans. We're the largest distributor of pet insurance, right? You name it, Nationwide probably has it out there. And what that allows for us to do is during market upsides and downsides, we're not taking on big risk, right? It's diversified and we're privately held mutual company. We're not doing quarterly earnings reports. We're not at the behest of stockholders. We are a mutual company based out of Columbus, Ohio. And when you think of a mutual company, it's how can we really benefit the end member as much as we can. And what I always like to show is we've bought plenty of insurance companies and folded them up underneath the Nationwide name. And we've looked out there and we've actually said, you all were charging too much. We're going to decrease the cost on certain IULs and VULs. We're going to decrease the cost on some of our current assumption ULs. So we have never raised cost of insurance on our in-force blocks of business, and we have actively decreased cost of insurance. So that is what you want from a client, from an insurance company, because this is not a 5-year guaranteed annuity, right? This is they're going to be in this for the long haul, the next 20, 30, 40 years. So you want a company that you can trust. And that comes with carriers that actively let you know what's going on in the contract. So whatever is illustrated, whatever you all go with and sign the application, we want to make sure that we can do everything on our end to make sure that stays on track. So we will actively send out policy management material so they're able to see exactly what the premium schedule is, what they ended up funding it with, right? It oftentimes doesn't match what you plan on funding and what you end up funding. And then distributions and all sorts of stuff. We're going to actively notify you and the client of everything here. And my favorite one is this automated income monitoring. So what we do is, you hit 65, it's time to take those distributions for 15 years. You're not filling out a form every year for 15 years. You're going to fill out one form, tell us exactly how much you want to take. We will distribute that amount out. And then every year, we're automatically going to do that. But we're also going to send notifications that, hey, the market went up, right? We now could take additional out, or the market went down. We may need to revisit how much you're taking in that calendar year. So just really proactive material right there. I am seeing a couple questions here. I'm going to go ahead and answer those questions, and then I will pivot over to a sample illustration so we can see that. So one of the questions is, at what age does it not make sense? I kind of answer that with, what is our target market, right? And I answer that with its ages 18 to 64. I know that is a broad range of a target market, but because it is simplified issue, that's really where it's going to make sense. Let's get this issued. Let's get it out there as quick as possible with as low cost of insurance. So that's where it makes sense. It's not to say over 64 doesn't make sense. I had a client the other day that we placed one in force. He was 68 and he got approved. His current contract was going to lapse due to the cash value in there, but it had over $1 million of cash value. So we moved it over, gave him low cost of insurance. And now this client is taking annual distributions every year the rest of his life. So it's so flexible that target market's 18 to 64, but it's pretty wide here.
It does issue to 80, right, Josh?
It is ages 18 to 80. I will tell you.
But as you scale up, it becomes harder and harder to qualify. Once you get past that 65, you've got to be really in the preferred health category.
Nationwide has always been the most competitive up to age 70. So can we issue it up to age 80? Absolutely. But where we're most competitive is up to age 70. So over that 64, that's when full underwriting would take place. There's a question on here. Is this available in New York? So it is not available in New York. We are available in 48 states. So every state except New York and Montana. We will not be filing in Montana. At some point, we will file in New York, but I'll tell you, this product's intended for your high income earners, and New York clients that are high income earners probably have a home in Florida, right? Or they have a second home somewhere in the South. I'm in Florida right now. I travel to New York frequently. It's cold, right? Those folks want to have a second home somewhere. If they do, we can issue it in another state. So we have options to get around that for New York, but if it is a New York resident that only lives in New York, would not be available to them, but those with second homes somewhere else, we can absolutely take a look at that.
Yes.
I'm going to pivot over to an illustration here just so we can really see kind of the nuts and bolts of how this works. I'll talk through a few kind of sales applications that we've seen some success with here. So in this example, we're looking at a 40-year-old male approved at preferred non-tobacco. So not our best risk class, just one below. He's putting in $200,000 a year for the next 10 years in this annualized payment column. So he's putting in a total of $2 million. The death benefit to start out, we want as low of a death benefit as possible. The lower the death benefit, the more we can maximize the cash. So when we're putting in that 200,000, the minimum that we could look at on this example is right under 4 million. So 3,990,000. There are 3 charges on this contract, and I'm getting in the weeds, but it'll make sense and it'll kind of tell the story here. And it helps to transparency. So there's 3 charges on this contract. We put that $200,000 in. First charge we're going to take out is the insurance cost. This is still insurance at the end of the day. So in that middle column, you'll see 4629. That is the insurance cost on this transaction. I mentioned earlier, think buy term, invest the difference, and one tax advantaged wrapper. We are guaranteeing this insurance until retirement. So till age 60, 65, or 70. In doing so, you're getting a fixed insurance rate until that time is up. So 40-year-olds, we're guaranteeing it till age 60. That just happens to be 20 years. If you look at that middle column and you see it fixed for the next 20 years, reminds you a lot of 20-year term, right? It's fixed every single year during that term component. So we take that 200,000, subtract out 4629. The second charge that comes out is a state premium tax. Every life insurance contract out there has it, whether you realize it or not. It's typically coupled in with about 10 other fees, but we've eliminated those. So we just still have to call out the state premium tax. Nationwide does not receive any of that. It is a straight pass through to the state government. After we take that out, everything else goes into the cash value. So in this example, if you look at the second column from the right, you'll see that 204,963. We've put 200,000 in. I ran this at a 7% assumed rate of return. And immediately in year 1, we're showing net positive. If you were to put $200,000 in a normal contract, it's going to be about $100,000 after surrender charges, right? So we have so you really have that liquidity there. So where does that fit well? I mentioned the 1035 space earlier, corporations as well. I do multiple group cases with this because the corporations love to see high early cash value. They don't like to see a hit to their balance sheet. They want to see the high early cash value. This fits well in that space. So our goal here, 3 charges. The third charge is on that cash surrender value. So what is American Funds charging? What is Fidelity charging? There's where that third charge comes into play. If you're taking an advisory fee from it, that is where we could call it a fourth one, but 3 are built into the contract. So we want to get as much money into the cash as quickly as possible and allow you all to actively manage these assets. It is really by term, invest the difference in one tax advantage wrapper. So we start this off on an increasing death benefit. If you look at the bottom right-hand column and corner, we are up to about 4.7 million of cash surrender value after 20 years and about 8.7 million of death benefit. So we like to start this on an increasing death benefit. It allows us to get more cash inside the contract. It's also when people would need more life insurance, right? Early on in life, they have a mortgage to pay off. They have other debts that they need to pay. That is where this works out well in that space. But what we want to do afterwards is we want to crunch that death benefit down as low as possible to the cash. That's what's called going into the corridor. We want to get the cash value and the death benefit as closely aligned as possible. That way we can get as little charges in this contract to maximize the cash. So if we look at those owner withdrawals and owner loans, we take the withdrawals out first. That's a withdrawal of cost basis. And then we take owner loans out. I really view the owner loans as that's the gain that would have been in a brokerage account, right? We take cost basis out first, and then we have the gain. So if we look at the gain inside of here, we're looking at about 6,750,000. This is where you really want to take into account what is the cost of insurance versus the cost of tax. So is the insurance cost cheaper than what the taxation would have been if this was in a brokerage account? Because we're taking this out tax-free. So when we compare the two, with this being such a low-cost chassis, it is significantly cheaper to utilize this than it would be to pay taxes in a brokerage account. So we're just really moving over assets, right? Moving them into a more tax advantaged bucket for you all to manage. And also you get death benefit with it, right? If something were to happen, beneficiary is taken care of, that also goes typically right back into your AUM, right? So lots of different options that we can look at this with, the 1035s, the COLI space. One that I really like is on young individuals, right? So think about a med student. They're going to make some good money once they get out of med school and they sign their first big contract at a hospital, but they typically don't have excess cash early on while they're in residency. So this 4629 here in the middle of that protection premium, that is the minimum, right? So the minimum premium is the protection premium. What is needed to keep this in force? You don't have to fund this with $200,000 a year or $500,000 a year. You can fund it with that minimum premium. Once that person's out of residency and is making additional money and has cash flow, that is where they could then put in additional premium. I actually did one on a RIA recently. So it was on two partners at the RIA, and they did not have excess cash flow at the time. They were selling their business and they were having a liquidation event in 5 years. And what they were doing is they're funding this at the protection premium level for the next 4. Once they have their liquidation event, that is where starting year 5, 6, 7, and 8, they're going to pump additional cash into this. So it is extremely, extremely flexible, and hopefully that's coming across as we go through this.
Yeah. A couple questions on that I saw pop up. Well, first of all, I have one, Josh. So in this, for example, would you recommend illustrating, let's say, those additional premiums in year 5, 6, and 7 is where you think it's going to be? Like, let's say the client says, well, I don't know, it could be 6, 7, 8, it could be 5, 6, 7. What do you recommend in that situation? Because that's kind of a different way of thinking about it than a normal illustration that we would run on an IUL or a VUL. It would be kind of like, okay, we have to fund this in a certain way to get to the end goal. This one seems a little bit more flexible when it comes to that. But how do we set the policy up for success? What pointers do you have on that?
Yeah, so I always illustrate with as much information as you have, right? But so if they think it's going to be years 5, 6, 7, and 8, let's illustrate that now. But also, life changes. We get that, right? Yeah. Income can go up, income can go down. I encourage that, we always keep that up to date. Fold this into an annual client review or your quarterly review and have those conversations. Also, if you think about this, we're going to proactively send in-force illustrations every year. Let's take a look. Where are we at, right? Do we want to put more money in? Do we not? So it's really just a good conversation to have, continually update that. You actually can just go to our website with the click of one button. You're going to get an immediate in-force illustration at all times. So it's just very simple, very easy to look at in the event that you want to change something. We also have, I think our service center is up to like 300 or 400 people now. So call us, we answer within 20 seconds, and they can run one live for you over the phone.
And one question from the crowd here is, are there tax-free loans available, which I know that there are, and can it be done on a single premium payment with a guaranteed death benefit regardless of the cash value? That was the question. Yes. I think that's a couple questions in there, but a
few questions there. Yeah. So on the tax-free loans, yes, absolutely. These are tax-free loans. That's the whole purpose of this contract, right? Where we see the main target market is get as much cash in as early as possible, take out those tax-free income first as a withdrawal of cost basis, then switching it over to tax-free loans. We charge 3% on those loans, and we credit back 3%. So that's how we lock in the tax-free aspect of it, is having it come out as a loan. So it is net zero. That starts in year 6. Most carriers, that starts in year 11. So we're giving it to you 5 years earlier. In terms of single premiums, yes, this can absolutely be a single premium. I see oftentimes where, again, reallocating assets. Let's move $2 million. Let's move $3 million over from a taxable bucket to a now tax-free bucket. So we can definitely do it as single premiums. What I think the end here, the guaranteed death benefit, it is guaranteed during the protection period. So during that term component, so up to age 60, 65, or 70, that is with regardless of the cash value, as long as this protection premium in the middle column is being paid. So as long as we have that 4629, the death benefit is guaranteed during the protection period. It is not guaranteed after protection period. Reasoning
Right.
behind that is we built this and priced this to take income. If you have a contract out there that has a guaranteed age 100 and at age 70 you try to take income, the guarantee goes away, right? So since it's
Yes.
priced to take income, there's really no need for us to provide a guarantee for longer. So 60, 65, or 70, as long as you're paying that protection premium.
Got it. Yeah, I think that covers the question. Perfect. So in this scenario, this individual is paying $200,000 a year, total of $2 million. And on the back end, they're pulling out, go to that second page, they're pulling out $500,000 basically every single year from year 25 to year 39. So I'm bad at math, but that's 14 years, 14, 15 years that they're pulling out $500,000. And remember, they're doing that in a tax efficient way where if they pass away, they are taking that death benefit and reducing it for the value of the loan, and the family is getting the rest. So if we look at, 80 is kind of early, but let's just say something happens at 80. Not only have they taken $6.744 million out, but they're getting another 800,000, that far right-hand column that's going to their heirs in the form of a tax-free death benefit, net of the loan, of all that money that they've taken out and all those cruises that they've gone on. All the nephews and nieces, they still get some piece of income tax-free death benefit. And Josh, I would even say if it's managed correctly, that could be used for long-term care, depending on how it's managed and what the amount of the loan is. So the point I'm trying to make is that this policy, if it's managed correctly, gives you the opportunity to have flexible death benefit protection, secure your insurability, manage the COIs in the early years. In the middle years, it allows you to have that tax-free death benefit. And tax-free distributions. And if you don't juice it all the way and rip everything out of it for income, there's probably a strong likelihood at the end you could use a legacy plan or a long-term care plan at the end. So I really see it as a Swiss Army knife for that younger individual that is looking for some long-term care, long-term planning throughout their life and using insurance. And I think there's real power in not having the loads and the fees. I bet if we were to compare that against another product, the engine gets started and warmed up much faster than something that's being dragged down by those fees and those loads.
Yeah, really good points there. And one other one that I missed and I think is important for everyone on the call here is the advisory fee, right? So if you think about this, that is where a lot of folks are headed, is to an advisory-based model or a fee-based model. And so this really just incorporates how you're doing the rest of your business, right? You're doing 99% of your business in a fee-based model, and then outside you've got your insurance. And now we're just bringing your insurance into the play. You can see here, I mean, it's pretty sizable. I just ran this at 50 basis points, but you can charge anywhere from 0 to 150 from the contract directly, or if you're billing it outside, bill whatever your ADV states. But from the contract inside, we allow for anywhere from 0 to 150. And this was just at 50 basis points. And you could see after 30 years, they're projected at $486,000 of advisory fees. Right. So everybody is in alignment here on where the assets are. And I think this is the first insurance product that I've seen that every person is profitable in the same aspect and in the same way. Yeah. I like that it just adds to where you're already doing the rest of your business.
Agreed. And from the client's perspective too, if you ran a 20-year term insurance for the cheapest thing on the street, you're looking at these guaranteed premiums. That 46.29 is probably only about 10 to 15%, maybe a little bit more higher than what they would look at for the cheapest term out there that has none of these features and benefits inside of it. So, if you're talking about value, I only say price is an issue in the absence of value. I think that the value that you get for paying a little bit extra in comparison to a regular term type sale that you would do for a key executive, just thinking about a corporation, if they're going out and buying insurance on a key executive anyway, why would they not want to have a wrapper inside of that policy that provides for some tax deferred growth. It only benefits the corporation. They can put money in it or not, if they choose to, going down, but still maintain the death benefit protection on that executive. So I think with the labor market the way it is and retention of employees, there's tremendous traction there as well. And I'm just super excited about the product. I haven't been this excited about an insurance product that's come out in quite a few years. So I appreciate you jumping on with us. I think we'll give it a minute or two. If someone has any additional questions, now would be the time. And if not, Josh, if you don't have anything further, we'll go ahead and wrap it up.
Absolutely. And I know you all on the call here know how to reach me. So feel free to reach out to Dan and he'll make sure he gets me looped in if any questions come up here. So
yes,
appreciate. Go ahead.
Go ahead, Josh.
I was just going to say, I appreciate you all having me on here. Anything I can do to help, just let Dan know. He'll loop me in and we'll make sure we get you taken care of.
Yeah, and I don't see any other questions here. And Josh, you've always been very responsive and great help to me. There is a Josh on my team as well. So when we're saying call Josh, we're not necessarily saying call Josh V. It might be Josh Lipson. But remember, you can always get us at Alpine Brokerage Group. Dial us direct at 800-888-2352. You can go on the website and message us or drop a quote in at abgelite.com. And I always end on this. Rest assured, you don't have to reach out to us. We're going to reach out to you. So appreciate everyone being on the call today. Thank you, Josh. Good luck in your March Madness pool. I'm sure you've got quite a few going on right now. So good luck with that. And we'll be following up with everyone to talk about this very innovative product. And we appreciate your time today. So have a great day, everyone. Thanks so much. Talk to you soon.
Thank you.